Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
And I'm John Tucker, filling in on Bloomberg Intelligence.
On today's show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why Tesla investors may be concerned about CEO Elon Musk's new political party.
And plus, we're going to look at Bloomberg Intelligence's 10 companies to watch in the third quarter of 2025.
But first, we begin with the airline industry.
And this week, Delta Airlines reported quarterly earnings and also reinstated a profit outlook for the year. The company also said travelers are coming back.
For more, John Tucker and I are joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
And first, we asked George for his take on Delta's recent earnings.
They reinstated guidance, but at a lower EPS than they had initiated at the beginning of the year. I think the market still looks a little bit soft to us. For sure, fuel prices are giving airlines a bit of a bolster on the bottom line. But I think what we heard was on the demand side was more of the continuing story, and that is that premium is holding up really well, and Delta is going to do very well there because of their loyalty programs and such. Basic economy isn't, and if you look at Delta's, price paid per mile flown for customer, it was down in every single market that they served, or maybe flattish in Latin America, but all the rest of the market's down during the quarter. So to us, it looks like a market that still needs to have capacity come out. And some of it will in the second half. So.
The CEO pointed to progress in trade talks between the U.S. and other countries and the potential for some geopolitical conflicts to abate. I mean, the flying public really, I don't know, are they really thinking about this when they book a flight on Delta or any other airline?
Yeah, I mean, so when I think of that, I think that's going to largely benefit his international business. I don't know, Paul likes to pick on me because I get to Paris for Paris Air Show, every other summer. And when I was in Paris, it was teeming with Americans. So it didn't seem like, even with protests going on around, it didn't seem like demand was off for international travel, at least, anecdotally in some of the places I've been to. So I don't know. I mean, I think it takes a little bit of demand off, maybe a very little bit. But right now, I think the international traveler seems to be rolling right over top of that and going anyways.
George, how does an airline take capacity out of the system? Is that just going from like 10 flights between Newark and Miami a day to, 7 or 8?
I mean, I think ultimately you got to park airplanes. It's a capital intensive business. You don't want to buy those airplanes and not utilize them. You take your old stuff, you park it, you maybe retire it, sell it off. But what we're seeing as 3Q develops, and so we'll watch this closely to see what it does to demand, is we're seeing that the low-cost carriers, Spirit, Frontier, look like they're taking large portions out of their plan for 3Q. Now, it may not hold. They may add some of those routes back, some of those seats back, but we're seeing numbers down 20% in some of their capacity. On the full-service side, United and Delta is still adding. United adding the most, I want to say 5-ish, 6-ish%. Delta adding 2-3-ish%. An economy that's not growing that fast. American look kind of flat, meaning the economy's growing at rates, sub 2%. So it feels like the big full service are going to push through here and try to push through and continue to subsidize the back of the cabin, that basic economy with the front of the cabin strength. I feel like at some point they'll break that front of the cabin. I think that's sort of how the industry always works, but we'll see.
In none of these reports do I see anything mentioned about jet fuel prices. Should we be concerned about that?
Well, I mean, right now it's a tailwind, and if that reverses, could be a problem, right? But I mean, jet fuel prices are down because of slower global growth, right? I mean, I think the geopolitical backdrop doesn't help it, but it doesn't seem to have pushed prices up firmer. I think I saw Saudis are talking potentially about reducing some of the capacity adds that are coming on. I don't know if that sounds strong enough yet, but if jet fuel turns, that would work against them. Because again, we've got an airline business. If you look at Delta, they added 3-ish% capacity or around there for this quarter, and revenues were flat, right? So they're adding capacity and revenues are flat. I generally don't like that kind of backdrop.
Business travel, Delta actually kind of called that out as perhaps corporate travel is quote unquote strengthening. Are you seeing that across the industry? And where's corporate travel versus pre-pandemic?
Yeah, so they're not telling us anymore, right? And usually you tell us when you're really excited about where it is. Look, I think the summer flying seasons are all about leisure. What I heard was that they were having weaker pricing power in sort of the off-peak demand times. And my read-through on that is that summer leisure traveler, where they know they got you, right? All my friends call me, they go, hey, George, I hear airfares are down, but I'm trying to travel over July 4th week on vacation with the family, and I'm paying a crazy price. And I'm like, yeah, because you're going when everyone else in the world wants to go somewhere, right? So when I read off-peak, I also think that's probably a little bit of business travel. And so I don't know that it's going swimmingly, and they're not giving us numbers. What I heard was kind of stabilized, but I didn't hear something that sounded like it was getting much better. And again, summer's about leisure.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
And we move next to the antitrust space.
As the antitrust enforcement policies on President Donald Trump's administration take shape, dealmakers and large businesses hoping for relief could see a glimmer of hope in some areas, but not all.
That's according to Bloomberg Intelligence, which recently took a deep dive into what the antitrust space could look like during the second half of the year.
For more, guest host Norma Linden and I were joined by Jennifer Rhee, Bloomberg Intelligence Senior Litigation Analyst. We first asked Jen what the antitrust environment is looking like under the Trump administration.
You know, there was a lot of uncertainty going into the election during the fourth quarter of last year, but I think there's some really good signs for those companies that want to engage in big deals going forward. And the main reason is because Trump's antitrust enforcers are willing to accept settlements with a remedy to allow a bigger deal to close, essentially meaning that if there's an overlapping product and there'd be too much concentration in the market for that product line can be sold and the larger deal can get closed. And the Biden administration essentially refused to do that. They thought if a deal was problematic, we're just going to sue it and try to block it. And it led to a lot of lawsuits, a lot of abandonments, and a lot of deals that just didn't get signed to begin with. So because we're seeing this sign that deals can get settled, I do think we're going to start to see more bigger deals getting signed up in the second half and probably next year too.
So, for all these agencies within Washington, they obviously feel the presence of President Trump very keenly. The folks that are in charge of the Federal Trade Commission, the Department of Justice, how much independence do you think they have at this point?
You know, Paul, probably not very much. You know, in the past, in particular, the Federal Trade Commission was supposed to be quite independent. And really, it was because it had 5 commissioners, only 3 of which could be from one political party, and they needed a majority vote to take any action with the deal. But President Trump has fired the 2 Democrats. So we now have 3 Republicans, and we have 3 Republicans that very much are behind him and his political visions. So I think that they will essentially do what they think he wants done. And we have seen an example of that because they did clear a deal between 2 huge ad agencies, Omnicom and Interpublic, with what we call a behavioral agreement, which they have said that they don't tend to want to take, agreeing that they wouldn't prevent advertisers from advertising next to content that was right-leaning or expressed conservative viewpoints that they might not agree with. So that was very much kind of in line with this administration and what this administration wants. So I do think we're going to see alignment in terms of what these remedies are and the deals that get cleared with what Trump is saying and with what Trump wants.
Mm-hmm.
So Trump terminated 2 Democratic FTC commissioners back in the first quarter of this year. And of course, we know this did raise some significant constitutional concerns in terms of the commission's historical independence and, of course, enforcement efforts. What has this really signaled in terms of potential policy changes?
Well, the thing is that, first of all, all of these challenges are going up to the Supreme Court. And we do think that this is going to stick. We do think that because of some of the other decisions about other agencies, that even though the 2 Democrats do have an ongoing lawsuit about their termination, we think that probably the Supreme Court is going to side with Trump and they are going to remain terminated. For practical purposes, as I said, I don't think that there's very much impact here because you do need a majority vote to settle or to sue to block a deal. So you need 3 out of the 5. In the past, we have seen that the FTC's operated on a very sort of bipartisan or nonpartisan basis. We usually have a unanimous or maybe a 4-1 decision, but it hasn't been that way. Starting with Biden, we were seeing a lot of 3-2 decisions where along party lines, right? So I think that we probably would have continued to see that. Even if the 2 Democrats were still there, you'd have the 3 Republicans. You'd probably get your 3-2 vote to do whatever it was that the Republican contingent wanted. So from a practical standpoint, it's not going to have that much impact on the decision-making for deals of this FTC.
Are there any deals that are currently being held up or being scrutinized that maybe the participants are saying, oh boy, now we're going to really sail through, and we thought maybe under Biden it could be a tough slide, or anything we should keep an eye on?
Paul, the one I'm really interested in is the Google Wiz deal. And I say that because we know this administration is no friend to big tech, and we know that they're staying really aggressive on the monopolistic conduct side, where Google and Apple and Amazon and Facebook have all been sued for monopolistic conduct. And to me, that deal is very interesting because just from an antitrust perspective, I don't really think it poses antitrust concerns. The concern would be that you have a cloud company that's marrying with a cloud security company, and they could foreclose rivals. But I think that there's ample competition on both sides, both on the cloud side and the cloud security side, that you probably don't have a very strong theory of harm. But we know that this administration doesn't necessarily love Google. I'm going to be interested to see what happens there, but I suspect we're not going to learn in the second half. It's probably going to push into the beginning of next year.
All right, thanks to Jen Rhee, Bloomberg Intelligence Senior Litigation Analyst. And just ahead, we're going to look at what President Donald Trump's new tax bill means for the pharmaceutical industry.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm John Tucker. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm John Tucker, filling in on Bloomberg Intelligence.
We move to some news in the tech space.
And this week we heard that the AI cloud computing startup Coreweave is acquiring the data center operator Core Scientific. It's an all-stock transaction, and it's valued at $9 billion.
For more, guest host Lisa Mateo and I were joined by Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. We first asked Anurag how this deal benefits Coreweave.
When think about it, that they have capacity to process X number of transactions or the backlog that they have. With this particular deal, they are expanding their infrastructure. I mean, it's a very simple deal, as if they're just buying more factories to produce what they do. So it's as simple as that.
All right. So I'm not a tech person, but I know. Tell us what Coreweave is. What do they do, and why are they shelling out $9 billion to get bigger? I guess.
So in the purest of pure forms, they are just renting computing resources to anybody that wants to run an AI infrastructure. They are a very big NVIDIA shop. They basically buy GPUs from NVIDIA. They create a network or an infrastructure, and they give it to people to go out and experiment or do whatever they need to do on that infrastructure. It's no different than what AWS does, but very heavy focus on GPUs rather than the CPUs. So that's really the big difference between a pure play provider like Coreweave versus Amazon Web Services.
Now, if you can dig into some of the background, what kind of challenges has Coreweave had in the past? I mean, didn't they have a pretty dismal IPO?
Yeah, I think that's really the most important thing is, they everybody thought when they're going to come out as the first pure play, AI infrastructure IPO, it's going to be extremely popular, but it didn't happen. And the reason for that is because they need a large amount of upfront capital to build these data centers, and then the workload comes in over the next several years. So there's a lot of questions about whether there's going to be sustainability of this GPU demand going forward several years out. So that's why you are right. The IPO came at 40. In a few days, it was down to 35. But now we are seeing, the stock closer to 160 before this deal was announced. So we have talked about it before that, why aren't they doing a secondary when it's like $160 stock? So what they did instead is they used their stock to go out and buy another competitor. I shouldn't say competitor, but another company in that space so that it expands their capacity. And I think they're doing the right thing by using stock at this point.
Are there more Coreweaves out there, Anurag? Kind of more pure play AI stories, maybe the kind of the sausage of AI, if you will, the guts, that somebody could take public?
There are multiples of them there, but they are much smaller size in Coreweave. I would say there would be hundreds of them at this point because, you go out, you buy the GPU, you go out and start renting it out. In a long time ago, this high-powered computing was used for Bitcoin mining, and then when that's not in favor, these guys are renting out their infrastructure for other reasons. So there are other plays out there, but almost all of them are much smaller than Coreweave from a pure play point of view.
Now we digged into Coreweave. What about Core Scientific? What's the attraction to them?
I mean, it's just they are expanding the number of, the capacity that they have to process the transactions in a sense that Coreweave has a massive backlog right now. They have people wanting to use their services, and then these guys have to go out and lease it from, other companies like Core Scientific. In this case, they said, they have an agreement with them to lease their facilities. They just said, we'll buy it out and expand their size. And I think that's as simple as that.
All right, thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
We move next to the news in the auto sector. This week, shares of Tesla fell after recent news that CEO Elon Musk was forming a new political party.
Well, Musk said he's going to take on Republicans and Democrats with the America Party, focusing on House and Senate seats for the next 12 months.
For more, guest host Lisa Mateo and I were joined by Craig Trudell, Bloomberg Global Autos Editor. We first asked Craig why investors are concerned about Elon Musk.
I think they see all sorts of risks here. This is a matter of now, not just alienating Democrats, but also now going after Republicans and really sort of ticking off Donald Trump. And we've seen that with Trump going from, kind of biting his tongue when Musk was first attacking, the big beautiful bill to really going after Musk in a more sort of pitched way. And, so this is, a risk for him to sort of make himself an enemy of both sides of the aisle in Washington, potentially, but also, just a great big distraction after he's assured everybody, on multiple occasions, look, I'm going to, sort of get back to business and tend to Tesla more than I have been, since last year.
So I have to ask this question. Is there a board here at this company that can rein in Elon Musk here?
There is. You wouldn't necessarily know it from the actions of the board, right? To the extent that we've heard from the board recently, it's been to say, Elon's our guy. They batted down a report in the Wall Street Journal just in the last few months about potential succession planning at the company. I think the sort of read of that, a close read of that story, it wasn't necessarily the case that what the journal was saying was that they are, were actively looking to replace Musk. It was potentially more of a matter of sort of doing the job that you would expect a board to do. I should sort of, give them credit in that regard, that at least they're preparing for the potential of needing to look for a next CEO. But, Musk is very much in control of this company. And that was something that, the Delaware Chancery Court judge who threw out his pay package, really emphasized in her ruling last year when she said, he's very much in control of this company and its board. And, on those grounds, threw out his compensation package, which has created, another mess. And I think this political endeavors, only complicates the board's attempt to try and get him compensated in a way that he's going to be happy with.
Now, Craig, not too long ago, we heard Elon Musk saying, you know what, I'm going to get back to it. I'm going to focus on Tesla. This was after the last earnings. And now we're seeing the shift, right? He's talking about this America party. I mean, is this something that investors should be concerned about? He's kind of going back on his word there?
Yeah, I mean, I think, some of it's not the only way in which he's sort of undermined himself and potentially you've made investors question the things that he's been telling them, because he also, said to Bloomberg back in May that our sales are turning around, right? And that was not borne out in the deliveries numbers that the company reported last week. They had a 13% year-over-year decline in worldwide vehicle sales. That was almost bang on what they posted for the first quarter. So, for him to say, that he thinks in terms of political spending, he's done enough, that he's going to, do a lot less of it in the future. That was what he said in May, and this is pretty much 180 degrees different from what he was saying then.
All right, thanks to Craig Trudell, Bloomberg Global Autos Editor.
We move next to the biotech space. President Donald Trump recently signed a $3.4 trillion budget bill into law, which includes an extension of tax cuts.
The package represents a major political party victory for Trump, but what does this mean for the pharmaceutical industry?
For more on this, guest host Lisa Mateo and I turn to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. We first asked Sam what this bill means for the pharma companies.
So the one big, beautiful bill had in it a couple of things. Many things, obviously. I can't remember how many pages it was supposed to be, but
Correct.
For the pharma industry, I'm going to focus on two things right now, right? One is a good thing. So there is an orphan drug change that impacts the IRA and actually impacts some really big drugs here. What's an orphan drug? When you develop a drug for a patient population that less than 200,000 in the US, you're called an orphan drug. You get a special exemption. It really helps you in terms of your duration of time that it can be on the market, etc., irrespective of your patent expiry. It was all set up to help companies develop drugs for these underserved markets. 200,000, okay, it's not small. It's not big, but it's not that small. So it helped. One of the big drugs that had this was Keytruda, which is the biggest selling drug at the minute, and that's for cancer from Merck. So when IRA came along, it said what we're going to do is say your drug 2014 approval for Keytruda under orphan drug, great. If you're an orphan drug, you don't fall into IRA, the renegotiation of price and all that. But as soon as you get another indication, then that clock starts from the original date of approval. So if you had a drug, orphan drug in 2014, and you get some other indication in 2022, they date back the clock counting to 2014. That was terrible. It really means that nobody would want to do multi-indication tests, etc. So that's been changed. Once an orphan drug is, you can keep that date. And so what does that mean for Keytruda, for Merck? 1 extra year before price negotiations by Medicare. And that's a $20-30 billion drug selling something like 50% of its revenues in the US. That's a huge win for the industry.
Sam, another big, component of this administration's policy has been cutting funding or maybe threatening to cut funding for research universities. And I have long experience with Duke University, which is a huge medical center and research area here. What's your industry saying about those potential cuts?
Yeah, the industry itself is relatively quiet, Paul, because what they don't want to do is I don't know what the right phrase is here, shake the tiger's cage or whatever, rattle the whole set here. But in reality, there is I think what I heard, the last number was a 12% increase in applications to some of the top universities in Europe versus what they were last year from the US. So that's folks that would have gone to or wanted to go to Harvard. They're now looking at Oxford, Cambridge, Sciences Po, etc. These very brilliant universities across Europe. So there's that issue. But remember, In the OBBB, there's also another area where there is a cut to Medicaid spending. That's 11 million Medicaid covered folks that lose it. That will also have repercussions for pharma companies, healthcare in general. And of course, you go to a hospital, you don't have insurance, they're going to treat you. Who's going to pay for that? It's going to go on your premium. That's a tax on you. That's, let's see how this all pans out, but not good there either.
All right, Sam, I want to talk about the Medicaid cuts. I'm going to kind of put you on the spot there, but it's going to affect insurers who focus on Medicaid. They might lose customers. So what does this mean for, like, let's say, Elevance Health, United Health, companies that do deal with this?
Yeah, so they are clearly under pressure, and there's a risk for them. And one of the issues is exactly what you just said. This is completely upsetting the cart here for the insurers in general. The point is, I'm not convinced that they will necessarily lose out. I mean, we have dedicated expert analysts who cover the sector, etc. But usually what's going to happen is that if they're not making money elsewhere, they're going to try and raise premiums somewhere else, which is what I said to start with.
Our thanks to Sam Fazeli, Bloomberg Intelligence, the Director of Research for Global Industries and Senior Pharmaceuticals. And just ahead, a look at Bloomberg Intelligence's 10 companies to watch in the third quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm John Tucker. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm John Tucker, filling in on Bloomberg Intelligence. We move now to research from Bloomberg Intelligence titled Banking, Booze, and 007's Wheels. 10 companies to watch right now.
It discusses 10 companies to look out for in the third quarter of 2025. For more, guest host Norma Linden and I were joined by Tim Craighead, Bloomberg Intelligence Chief Content Officer. We first asked Tim to break down his recent list of 10 companies.
These 10 ideas are all part of a broader list of what we call focus ideas. Focus ideas are where our analysts around the globe, across regions, across sectors, have high conviction, fundamental points of view that they think are different from what the market thinks, anti-consensus, and importantly, they're catalysts coming up that we think can change market perceptions. And these 10 all have important catalysts coming up during the third quarter. And just to put it out there, you can see all of these focus ideas on BI Focus on the terminal.
Tim, what I like about these ideas, because people are always looking for ideas, long and short. You guys have the ideas, and what I really like about this research format is you have the triggers. What has to happen in order for this call to work on a particular stock? Aston Martin. I'm asking for Matt Miller. What's the call here on Aston Martin?
So the call on Aston Martin, as much as I like the cars, and obviously this is where the 007 reference comes from, they've got a really interesting new lineup of vehicles, but they're short on V12s. And notwithstanding the world of EVs and all that sort of stuff, high-end V12s from Ferrari and Lamborghini are hot. And you look at the inventory levels of Aston Martin on the lots, they're too high. We think that there's a capital infusion that's likely needed in coming months. And so we actually have a cautious view on Aston Martin from that perspective.
Tim, you all are always putting out super interesting stuff. I mean, we had 50 companies to watch in January, and then we had the quarterly update in April, and then, of course, now this story that's out. Loving the graphics here. How long did it take to put this together?
Well, it's an ongoing just process of working with our analysts in terms of where do we see these ideas coming from, and then our friends in Business Week like to pull together the graphics on these things. It is a good looking piece on the on Bloomberg.com.
Booz, Diageo. What's the story there?
Yeah, Diageo. ties in a little bit with a couple of ideas here. I mentioned Aston Martin. That's obviously a high-end consumer idea. And even though we're concerned about Aston Martin specifically, the high-end luxury vehicle market is good. Similarly with Diageo, high-end booze, high-end spirits, they are the world's largest spirits manufacturer, is doing relatively well. Their recent sales trends have been robust. We think that's going to continue to show through. There has been concern about things like tariffs and what could be the impact, especially from a U.S. consumer base. We're less concerned and we're optimistic. Another consumer higher end idea you guys know and love in the States is Dick's Sporting Goods. This is a classic good old consumer's growth story where not only do you know the store, but you might have been in one of their new bigger formats where they have that much more kit. Their sales trends continue to be quite good despite concerns about what are tariffs going to mean for consumer here or there. So those are all consumer ideas. There's certainly a common thread there.
You mentioned Dick's, and I'm looking at EasyJet, which of course we know is a low-cost British airline, and we have a sunny outlook here. But what do you think will be the most surprising call here for readers?
Yeah, it's interesting. In this instance, obviously this is not the high-end consumer. This is everyday consumer. Is that this isn't so much about the demand, which actually demand for travel and experience continues to be pretty good. This is more of a story on an operational basis. They're replacing a lot of older planes with newer planes that have bigger capacity. They're much more fuel efficient. So this is a margin story. EasyJet has historically lagged behind Ryanair, the other low-cost carrier here in Europe. We think that that's set to change.
All right, thanks to Tim Craighead, the Bloomberg Intelligence Chief Content Officer.
We move next to the digital media space.
In late May, the TV advertising platform Mountain had its initial public offering with shares trading on the New York Stock Exchange. It's under the ticker MNTN.
For more on this recent IPO and the latest in the streaming business, guest host Lisa Mateo and I were joined by Mountain President and CEO Mark Douglas. We first asked Mark to talk to us about going public.
It was about 6 weeks ago, and I'll tell you 6 weeks ago, it was not a given that you were going to take a company public. It was 2 years of planning, but seemed extremely last minute. I'm talking hours before we started the roadshow. We were still with bankers, Morgan Stanley, Citi, Evercore, deciding on the timing. And we were like, is there going to be a jobs report next week? Right. Is there going to be an inflation? Like, we just needed a clean window of time. And we got it done, and I think it helped a few other companies, kind of follow us. Like I grew up in New York City. You know how New Yorkers will throw their arm in between the elevator doors when they're closing, like to keep the elevator open. I feel like Mountain did that to the IPO market. Good. We just threw ourselves between the doors, kept it open, and a few companies have followed us.
Good stuff.
I did that the other day. It didn't work for me when I threw the arm. It didn't work.
Yeah, you want to get your arm back by the time you get to the other to where you're going.
You guys do a lot the ad business, right? And we talk a lot about AI, how it's affecting, companies and workers and just changing the corporate workspace. Yeah. How is it affecting the ad business?
It's having a really big impact in kind of two ways. One is, I think as a company, you have to be doing everything you can to leverage AI. So it's having a big impact on our sales, our marketing. Things like 3/4 of our revenue now comes from inbound leads, partially because we're leveraging AI technology to make our marketing more efficient. We're doing the same thing for our customers. Sales, our sales headcount is very stable, again, because we're getting more productivity. But then it's also affecting the business. I mean, ultimately, our customers are looking for their next customer. So they're using Mountain on streaming TV. They're using Meta on social, Google on paid search in order to leverage digital marketing to bring, to promote their products, or meaning our customers' products. And we're using AI technology to help identify who their target customers. So those TV ads are super targeted specifically towards you because you show behavior that this might be a product you're interested in. So it's AI across the business. And I'll tell you, if you're not doing that, you're losing right now. I mean, it's the intensity of it is is quite up there.
Talk about where we are in this migration of ad dollars away from what I'll call traditional broadcast and cable television to some of the more streaming platforms out there. It's just been a sea change. Where are we in that sea change?
We're pretty far along. If you go into companies like Disney or Comcast, NBC Universal, Paramount. I was just in Cannes Lion literally 3 weeks ago, which is
potentially, Lisa, the biggest boondoggle on the planet, bar none. And I've been there several times, and I can say that.
It's not terrible to be in the south of France while you're at a trade show.
Right.
I would agree with that.
In June, by the way. Rosé, they serve rosé with the Rice Krispies in the morning.
Well, we had a billboard up that instead of saying rosé all day, said ROAS all day, return on ad spend all day. Nice. But I was just there I had a lot of meetings with some of the biggest media companies, and they're only talk about streaming. It's like they're streaming first in terms of the way they think about their businesses. I'm talking again like a Disney. And so the customers, meaning at that event, the biggest brands traditionally, Mount were focused on the smaller brands, small, mid-sized businesses. Streaming is their focus. And I think cable television, I don't think they see a distinction. They just see it as we're going to meet people wherever they are. And where they are now is predominantly streaming. But if they're still on cable, great. We'll meet them there also. But it's a streaming world is kind of the answer to your question.
I have cable, okay? So, and the only reason I have it is because my husband wants to watch sports, right? So where does streaming stand with sports? Because we're hearing so many different things, right? The ESPN MLB contract, what's happening with that? Could it go to streaming? Like, could that be a big draw and a help for streaming?
Yeah, so the year started those same kind of conversations with live sport. So last year, live sports on streaming was very nascent, and this year that's kind of the focus of a lot of these companies. So I think you look 12 months out, there won't be any distinguishing aspect. If you want to watch NBA Finals, it's available streaming live. It'll be available cable live. There won't be any differentiating factor, except one, the brands will prefer streaming because they get to be very targeted in who they deliver the ads to. And the more targeted they are, the more efficient that spend is for them. So the brands prefer streaming because of the digital targeting capabilities. The consumer, you should prefer whatever you like and whatever is easiest to turn on and watch. What we want to happen is we just want to see everyone watching TV, however you like to consume it.
All right. The NFL, are we going to see a big Sunday package go to the NFL on a streaming?
Absolutely. And
really? Because that's going to be a sea change for a
well,
lot of people.
the other thing is when you bring in streaming, you bring in Amazon to bid on it. You bring in Netflix. And these are some of the literal, Netflix is worth over $500 billion. I don't know Amazon's current market cap. I assume it's way up there. And so if you want the highest level of competition as a media company, you're going to go streaming because that's where that money is.
Yeah, I'm just going to Netflix. Another great year. Does Disney, just 30 seconds left, is Disney the number 2 streamer out there? And is there room for 3, 4, 5, 6?
The Disney, I do perceive, I think both data and perception is number 2 behind Netflix. By the way, if you talk to them, they're not like happy and settled in at number 2. They're definitely going for number 1. I think there's room for a 3 and a 4, but there's clearly going to be a big consolidation for who takes that spot.
Our thanks to Mountain President and CEO Mark Douglas.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.